Welcome to today's webinar on tax planning. Many taxpayers believe a good tax preparer will save them money. While I would agree that this is true, there's only so much that a tax preparer can actually do to minimize taxes when preparing your return during tax season. Where the rubber meets the road, where you really save taxes, is tax planning. As always, this webinar is for educational purposes and does not constitute advice. We recommend all students discuss their individual tax situation with us by scheduling a consultation. My name is Thomas Jones and I'm the tax manager here at OTA Tax Pros. So, tax planning. There's many different strategies ranging from simple to complex, from commonplace strategies to borderline questionable constructs that make you wonder, is this legit? Well, today I hope to introduce some of those broad concepts and principles that underlie the most common tax planning strategies. And these can be broken down into three main categories: timing of income, assignment of income, and conversion of income. Timing of income recognition. The usual advice is to defer income and accelerate deductions. Common income deferral strategies include contributing to qualified retirement plans, 1031 exchanges, and installment sales. Definitely the most common income deferral strategy used is retirement contributions. On the flip side, we try to accelerate deductions sooner. Among the many ways to accelerate deductions are prepayment of deductible expenses, electing mark-to-market for trading securities, Section 179, special depreciation, and carrybacks of future losses. Now, the easiest among these is to prepay certain expenses, such as property taxes, business expenses, or medical expenses. At OTA Tax Pros, we often encourage our clients to pay for their tax preparation in advance. Not only does it save us time, which equates to less expensive tax preparation, but it also allows our clients to write off those tax preparation fees this year, rather than waiting another year to claim the tax savings. It almost makes me wonder, how come all the other tax preparers don't suggest this obvious tax saving tip? All this timing of income and deductions has a lot to do with what's called the time value of money. Essentially, if I had $1,000 now, I could invest it and grow it, making it worth more in the future. But this isn't recommended for every taxpayer. Sometimes the tax code requires large expenses or assets be depreciated or amortized over many years. Other times, taxpayers may be in a different tax bracket in a later year. Now, at OTA Tax Pros, when we make tax planning recommendations, we take into account future tax law changes, your individual circumstance, and how you invest in and grow your money. So it's important to get the right advice for you. Foreign LLCs, Nevada corporations, family trusts, you hear about them all over the media, and these are often all different kinds of assignment of income. But perhaps the most overlooked income assignment strategy is among family members. Parents can gift investments to children to be taxed at a lower tax rate. Kids under age 24 are subject to kiddie tax rules, and grandparents should also be cognizant of the generation skipping transfer tax. And anyone making a gift should also be aware of this, that they may be subject to the gift transfer tax rules. But in the right situation and planned properly, this method of income shifting has the potential to save thousands. Another strategy used in assignment of income is the use of a nonprofit foundation. Now, the tax laws get incredibly complex very quick, and the IRS imposes stiff penalties on improper use of a nonprofit entity. But especially for clients with a legacy to share, there can be some tremendous benefits with the proper guidance. However, this is definitely an area that requires competent guidance. Many different rules govern the assignment of income, which include assignment of income doctrine, income nomination, related party transactions, arm's length transactions, and don't forget there's the kiddie tax, the gift transfer tax, and the generation skipping tax rules that all come into play. So make sure you coordinate with a competent tax advisor who's aware of all these different rules. Now, here's a common example of how a LLC can be structured as a win-win to save taxes for the entire family. And this is an example of assignment of income in a tax planning situation. In this situation, we'll say the parents have 3 kids, all under the age of 24, and the parents have a tax rate of 25%. The parents earn an $8,000 net rental income from a property that they rent out. And this could work just as easily with trading income, dividends, interest, and other investments too. On the left, we have no allocation, no LLC. The parents just pay a flat 25% on the rental income after expenses, creating a $2,000 tax liability. Sound familiar? On the right, same scenario, but the couple had set up a win-win LLC through their tax advisor. Each kid gets $2,100 of net rental income, half of which is not taxable, and the other half which is taxed at 10%. The remaining $1,700 of rental income is taxed at the parent's 25% tax rate. The total tax between the kids and parents is $740. This creates a $1,260 tax savings each year. And we could take this scenario further and say 5 years down the road after the property is sold, that means the family has saved almost more than $6,000 on taxes over the last 5 years. And you can see it adds up very quickly. Let's move on to the last type of tax planning, which is about conversion of income. With long-term capital gain rates lower than ordinary tax rates and passive activity losses and limitations treated differently than capital gain losses, which aren't as beneficial as the net operating losses, it's easy for any tax preparer to get lost in the confusion of the tax code. In general, tax advisors will suggest ways to convert ordinary gains in income to capital gains. An example of this may be if a trader had $10,000 from capital loss carry forwards from several years ago, but now had a $5,000 gain from Forex trading. Because Forex income is treated as ordinary gains, it would not normally offset the capital loss carry forwards. However, by making a Section 988 election properly planned and timely made, the Forex trading could be treated as capital gains and would be absorbed by the capital loss carry forwards, potentially saving a couple $1,000s in taxes. Sometimes it might be recommended to convert income from something like capital gain income to earned income, such as an example to enable a taxpayer to take employee benefits such as health insurance or contribute to retirement like a Roth 401k. Some of these employee benefits may even be a deduction for the business and non-taxable to the employee, creating a huge benefit as the employee then receives non-taxable income. The opposite often applies for losses. Capital loss rules limit losses to only $3,000 per year. The rest gets carried forward. For a trader with a sizable loss, this could mean years before they get to write off all of their losses. However, elections like mark-to-market or Section 1244 founder stock election allows more losses to be taken in the current year, saving more money now, not years from now. Let's not forget the obvious one, converting personal expenses to business expenses. Your car, phone, internet, insurance, and electric bill aren't normally deductible. They're part of living and enjoying life. However, a business may be able to take a portion, if not all of these, as a deduction. Failing to plan doesn't just mean failing to save taxes. Attempts to minimize taxes after a tax liability has already been incurred runs the risk of being considered tax evasion. However, using a tax strategy to plan and properly account for transactions before the tax liability is created is perfectly legal and even recommended by the IRS. So how do you do what's right and avoid taxes, not evade taxes? Well, make sure that you use competent tax planning. Accurately account for all your transactions and properly disclose any positions you may be taking. And it's always better to overshare with your tax preparer. Let them make the decision on whether it's necessary to include on the tax return. On the other hand, tax evasion usually includes elements of fraud, which includes understatement of income, improper allocation of income, claiming fictitious deductions, questionable conduct of a taxpayer, and accounting irregularities. When is the best time to do tax planning? The best time for proactive tax planning is around October to November, referred to as end-of-year tax planning. Early in March or April, only a few months have passed, and any trader or business owner knows a lot can change in 6 to 9 months. However, late fall is ideal because there's less uncertainty, yet still enough time to implement game-changing tax decisions like incorporate or set up a self-directed retirement plan. We often hear students say, "I've been with my tax preparer for 20 years and they never recommended that strategy." Well, perhaps that's all their tax preparer is, a tax return preparer, not a strategist, not a tax consultant, not a tax advisor. Finding competent tax advice isn't easy, and proper tax planning is critical. Discuss with us about your unique individual tax situation. We'd love to help you put together a tax strategy. We look forward to working with you.